Welcome back. Learning objective 2, applying depreciation method to plants and assets. Depreciation is the process of allocating to expenses the cost of a plant over its useful service life in a rational and systematical manner. Okay? This cost application is designed to properly record expenses with associated revenue. Depreciation affects the balance sheet through accumulated depreciation, whereas it affects the income statement through depreciation expense. It is very important to understand that depreciation is a cost allocation process and not an asset valuation process. First, book value, that's the cost, less accumulated depreciation of a plant asset may differ significantly from its fair value. As a matter of fact, an asset can be fully depreciated, that is, have a zero book value and still have a significant fair value. Depreciation applies to land improvement, building, and equipment, and never land. Land is not a depreciable asset. During a depreciable asset useful life, its revenue producing ability declines because of wear and tear. So, for example, if we have like a delivery truck that has been driven like 100,000 miles, that truck will be less useful to a company than one driven for only 800 miles. Now, what are the factors that we consider in computing a depreciation? The first is the cost, and this is all expenditure necessary to acquire the asset and make it ready for its intended use. Two, we have the useful life. This is the estimate of the estimated life based on the need for repair services, life and vulnerability, obsolete. And lastly, we have the salvage value. This is the estimate of asset value at the end of the useful life of this asset. There are a number of depreciation methods that exist. Depreciation is generally computed using one of the three methods: the straight line method, the declining balance method, and the unit of activity method. Many times management select the method it believes best measures an asset's contribution to revenue over its useful life. No matter the method used, the total amount of depreciation over the useful life of an asset is its depreciable cost. A depreciable cost equals to the cost of the asset less its salvage value. So we have this example. Bill Peter purchased a small delivery truck on January 1, 2022. Cost $13,000. Expected salvage value $1,000. Estimated useful life 5. Estimated useful life in miles is 100,000. We're asked to compute depreciation using straight line, unit of activity, and declining balance method. We're going to come back to this question when we begin to do the declining balance and the unit of activity. So for straight line, under the straight line method, companies expense an equal amount of depreciation each year of the asset's useful life. Management must choose the useful life of an asset based on its own expectation and experience. To compute the annual depreciation expense, we divide the depreciable cost by its useful life. So here we have the cost minus the salvage value. This gives us the depreciable cost. The depreciable cost is 12,000 divided by its useful life gives us 2,400. Usually, if I want to get the percentage rate to apply to my 12,000, I divide the number of years. In this case here, we have 5 years. I divide 100% by 5, and that gives us 20. And that is going to be the percentage rate that you can apply to your depreciable cost to get the depreciation expense. Okay, so that's how they got the 20%. So 12,000 for the first year times 20% gives us 2,400. We notice that for the straight line method, it's the same amount all year all through the 5 years. And then we have our balance here of 1,000, which is what was going to be the scrap value at the end of the period. Our journal entry is going to be a debit to depreciation expense and a credit to annual accumulated depreciation. Sorry about that. Now, in some cases, you don't buy your equipment at the right, like on January 1. In this example, we are assuming that we bought this truck April 1, 2022. And because we bought it like after the first quarter of the year, we are going to take account in the first year it was placed in service only for 9 months. So that's going to be April included, May, June, July, August, September, October, November, and December. That makes it 9 months. So the 9 divided by 12 times the annual expense gives us 1,800. And because in the final year, that's in year 2027, we're still going to have 3 months that we need to account for to make it a complete 5 years. And so that's going to be January, February, March that we lost in the first year. We're bringing it into the last year before, we finally write it off. So we have the 3 divided by 12 times the 24,000, 2,400, 2,400, and that gives us 600 to give us a balance of the 1,000, which we have as our scrap value. But you always have to be careful, when that equipment or asset was placed into service, so that you're not taking a full year as opposed to either, half the year or partial year depreciation. All right, this is an example. On January 1, 2022, Iron Mountain Skid Corporation purchased a new snow grooming machine for $50,000. The machine is estimated to have a 10-year life with a $2,000 salvage value. What journal entry would Iron Mountain Skid Corporation make at December 31st, 2022 if it uses the straight line method of depreciation? So the first thing I notice here is that this item was placed in service January 1. Okay, so for that first year, we're going to take the full amount, right, of depreciation. So in year 2022, they want to know what is going to be our depreciation expense. So we're going to have our cost, which is 50,000, minus our salvage value, which is 2,000, times the rate. Again, I told you for me to get my rate, I have my rate, my depreciable cost, we find it to always be 100%. So the 100 divided by 10, that gives us 10%. Multiply that by the depreciable cost, which should be 48,000, that gives us 4,800. How do we journalize this? It's going to be a debit to depreciation expense 4,800 and a credit to accumulated depreciation of 4,800. The depreciation expense goes to the income statement and the accumulated depreciation goes to the balance sheet. All right, declining balance method. The declining balance method computes expenses using a constant rate applied to a declining balance book value. The name of this method is also called the accelerated depreciation method because it results in a higher depreciation in early years of an asset life. Now, this is an example, using the first example of bill, okay? So in bill, remember we had a rate of 20. For the reducing balance method, it's always times 2 of what the straight line method is. And so because that one was 20%, in this case, we're going to multiply by 2 to get a 40% rate. So our beginning book value is 13,000 times our rate of 40. That gives us 5,200. That's our accumulated depreciation for that first year. And now we have a book value of 7,800 when we subtract the 5,200 from the 13,000. In the second year, we have a book value of 7,800. We apply this rate to the book remaining, book value. And that gives us 3,120. I add this 3,120 to my 5,200, and that gives me 8,320. In order for me to find out what my remaining book value is, I subtract my annual expense, right, from my book value, and that gives me the 4,680, and we can go on and on like that. Where I feel like we're going to have a little bit of question is in the end of the year. Remember, in that question we're supposed to have a 1,000 scrap value. Okay, so once we're done, we have the ending book value to be 1,685. So we want to have a book value of 1,000. So we put in the 1,000 there, right? Times, minus, subtract it from what we have as our ending. That gives you 685, and that's what we have here. If we go by what we usually do, we should have a balance of 674. But because we want to have a book value or scrap value of 1,000, we take the whole amount of the 685 and place it as our annual expense for that year. And then once we're done with that 5th year, all we have left is the 1,000 that scrap value that we intended it to have at the beginning of time. Okay, so the expense was adjusted to 685 to result in a salvage value of 1,000. Now we also have this example of where this item was placed April 1, whereby after the first quarter. So just like we did the first time, once we are able to calculate our first year, right, we multiply 9 divided by 12 to get 3,900, just to account for 9 months in that first year. And then in the last year, right, we expense adjusted to 180 so that it will result in, again, a $1,000 scrap value. In the unit of activity method, useful life is expressed in terms of the total units of production or the use expected from the asset. So companies estimate total units of activities to calculate depreciation cost per unit. The expenses annually varies based on the unit of activity. So it's not the same, just like the straight line method is the same. The unit of activity method is not going to be the same expenses every single year. So in that question, we have a depreciable cost of 12,000, and we had a total unit activity of 100,000. When I divide that by the 12,000, it gives me $0.12. That's 12 cents, right? So this 12 cents is going to be applied to the rate or the miles driven every single year. So for year 2022, we had 15,000 miles driven. We'll just multiply the rate by that to get 18,000. In year 2, we had 30 miles driven, multiplied by the 12 cents, and that gives us the 36. In year 3, it was 20,000 miles. We multiply it by our cents, and that gives us 2,400. At the end of the day, we also want to remember that we want to have a balance of 1,000 as our scrap value. And then we go on. When we add up the expenses, we find out that we have the 12,000 and our scrap value is still there as 1,000. How do we journalize this? In the first year, we're going to have our depreciation expense of 1,800, accumulated depreciation of 1,800. Companies must disclose the choice of depreciation method in their financial statement or in related notes that accompanies the financial statement. This is an example of Southwestern Airlines, which is its notes to financial statement. It's saying that for property and equipment, depreciation is provided by the straight line method to estimate residual value over periods ranging from 23 to 25 years for flight equipment. Now, sometimes management of a company should periodically review annual depreciation expense. If wear and tear or obsolescence indicates that annual depreciation is either inadequate or excessive, the company should change the depreciation expense amount. Now, whenever a change is required, the change should be made in the current year and future years, but never period. You don't go backwards. This change is considered to be a change in estimate and should not be considered to be an error. We need to know that for us to determine the new annual depreciation expense, the company first computes the asset depreciable cost at the time of revision, and then allocates the revised depreciable cost to the remaining useful life. Okay, so we're going to see that in an example. So let's just pay attention. So Arcadia purchased equipment for 510,000 with an estimated useful life of 10 years and a salvage value of 100,000 at the end of that time. Depreciation has been recorded for 7 years on straight line basis. In 2022, that's the year 8, it determined that the total estimated life should be 15 years with a salvage value of 5,000 at the end of the year. So, okay, at the beginning of this life for this equipment, it started with a 510,000 with a useful life of 10 years. Okay, so what is the journal entry to correct in the period years? Nothing. Okay, we don't do anything to period years. Now, but in the year of calculation, we're going to first find out how much we have depreciated in the last 7 years. So we have our equipment cost to be 510,000, the salvage value to be 10,000, depreciable base to be 500, useful life, that's 10 years. So when I divide that, I get 50. So every single year for the last 7 years, we have deducted 50,000. Now that gives us a total amount when multiplied by 7 of 350,000. Next, we now want to determine what the new book value is. So we are deducting the 350,000 from the 510,000 to give us 160,000, which is the net book value as at this 8th year. So calculation of depreciation expense for 2022 year 8 is going to be, right, 160,000. The new salvage value we're told was going to be 5,000. Now our new depreciable base or cost is going to be 155,000. We're going to divide that by the remaining years. Okay, the remaining years, and that gives us an annual depreciation of 19,375. So our journal entry for future years is going to be what? 19,375 accumulated depreciation, 19,375. Impairment. Impairment is a permanent decline in the fair market value of an asset. So as not to overstate the assets on the books, the company records a write-down whereby the asset cost is reduced to its new fair market value during the year of decline. So we're going to have an example of that depreciation again, and then that will bring us to the end of this module. So Chamber Corporation purchased a piece of equipment for 36,000. It's estimated a 6-year life and a 6,000 salvage value. Thus, straight line depreciation was 5,000 per year. Okay, that is the 36,000, which was the cost of the equipment, minus the 6,000, then divided by the number of years, which is 6, which gives us 5,000 per year. At the end of the year 3, before depreciation adjustment, it estimated the new life to be 10 years. Remember that in this question, we already have 6 years put in. But now the new life is going to be what? 10 years. And the new salvage value is going to be 2,000. So we're going to first compute how much we have taken for the last 6 years. So we have, or for the last 2 years, I'm sorry. So we have the cost, the equipment cost to be 36,000, the salvage value to be 6,000, depreciation base, okay, is 30,000. The useful life is divided by the depreciable base, and this gives us 5,000. Now remember, in that question says in year 3, that means they are not yet done with year 3. So we're only going to calculate the expenses or the depreciation for 2 years. So that's 5,000 times 2, which gives us 10,000. Okay, so we're going to find the net book value after 2 years. So the net book value is the 36,000 minus the depreciation we've already taken for the last 2 years, which is 10,000. That gives me a present net book value of 26,000. After we get that, we're going to now find out what the new depreciation rate is going to be. So we're saying that our new salvage value is going to be 2,000. Our depreciable base, when we deduct that, is going to be 24,000. Now the remaining life is going to be what? 8 years. Okay, annual depreciation is 3,000 when we divide that. Again, because the set is 10 years, we're taking off the 2 years that we already did. So that gives us a balance of how much? 8 years. So our annual depreciation is now going to be 3,000. What's our journal entry? Depreciation expense 3,000 and accumulated depreciation 3,000. And I think that brings us to the end of this module. See you in module 3, where we talk about explaining how to account for disposal of plants assets. See you there.